Very good morning to everybody who are attending today's session. So before starting the session, I'd like to give a small disclaimer that this session is just on a broader level of understanding how income taxes are structured in India. So this webinar is intended to help people who are just coming into the tax bracket, and there will be some women who have just started working, or they are coming back to work after a long gap and who have just started filing taxes, and which will help them understand a lot about how their incomes will be taxed, and where all do they need to go and look for information, and what are the things that will help them optimize their tax liability, and help them into more informed decisions related to tax and investments. For any advanced tax related queries or specific situations or concerns, we'd like to tell you that we'll be able to help you on a one-to-one basis, maybe at the end of the session with a Q&A, or if it's something which involves a deeper discussion and understanding, we can get in touch post discussion. So let's begin. So today's agenda is we'll see all about all the aspects of tax planning, starting from the heads of income, old tax regime, new tax regime, and how do you have to plan for the same? How can you optimize your tax liability? And then we'll extend the session with some financial planning, financial freedom, and wealth creation knowledge, which is in line with your tax planning and investment planning. Both go hand in hand. How do you optimize the same for now and for the future? And then we'll end the session with Q&A. So when it comes to tax planning, as the word itself says, it is tax planning. You have to plan your taxes in advance. For example, for the year that is coming, the 2023, the financial year 23-24. What are your estimated incomes for the year, and how do you reduce your tax liability with tax planning? So tax planning is nothing but how do you optimize your tax discounts, exemptions, rebates, and see to it that very minimum of it goes into as a tax liability. Of course, there is when it comes to salaried individuals, one can say that there is very less scope, but within that scope, sometimes what happens is people are do not have the time or do not have the inclination to get into these things, and just tend to ignore certain parts of their salary structure, and how to go about investments for tax planning. So it is important to understand that these investments are made to help you reduce your tax liability, alongside help you build a corpus as well. So what is it that you can do as an individual to make the most of these facilities and provisions that are available under the Income Tax Act? Okay, so that is all about why one has to do tax planning. So yeah, like I said, these are the advantages of tax planning. It increases your take-home salary by reducing your tax liability, or in a way ensuring that your take-home salary increases, so that you have much scope for better investments, better savings, planning for the future, retirement planning, health and life insurances, and everything that covers. So let's begin with the first thing that comes to anybody's mind is advanced tax. So most of them are not aware of what is advanced tax. Advanced tax is nothing but paying your whole year's taxes in small installments every quarter on the estimated income for the year. For example, whatever incomes you are expecting in the year 23-24, from April 23 to March 24. So what is the expected income from your salary, from your rental incomes, from your any other passive incomes, and how are they taxed? So what is the total tax liability you're expecting at the end of the year, and how you can pay it in installments rather than paying at one shot in the month of March. Sometimes what happens, it becomes a too big amount to set aside if it is to be done at the end, right? So the government has come up with provision to pay your taxes in installments during the whole financial year. It is also in a way known as pay as you earn tax, right? So as per section 208 of the Income Tax Act, so every person whose estimated tax liability is coming over 10,000 rupees, right, is expected to pay advance tax. Now, what are the due dates for making these advance tax, payments? So, this column refers to all the SSCs, except the ones who file their taxes as a presumptive income. That is section under section 44 AD and section 44 ADA. So, for them, there is no need to pay under any advance tax. They can directly pay one shot tax at the end of the year, that is in March. So, for all others, who are expected to pay advance tax. 15th June, you have to pay by 15% of the total tax amount. By 15th September every year, you have to pay 45% of the advance tax amount. And 15th December, 75%, and 15th of March, you will cover all the 100%, whatever is left. So, those are the advance tax deadlines. Which ITR now, you have to file your, ITR, right, by 31st July. So, which is the form that is applicable to you? ITR 1 is nothing but, a very simple form of tax filing where you do not have, any individual or a HUF which doesn't have, it's very simple. They don't have multiple properties or anything or any other, major sources of income. It's just salary and one rental income and things like that. So ITR 1 is the one which is applicable to you, which is also called as ITR Sahaj, right? So you can choose ITR 1 form and pay your taxes. So this is applicable to individuals where there is a salary income. There is another, agriculture, for example, agriculture income which is exempt. There are no capital gains, but there is one, house property from where you are getting rent. So rental income from one house property. There is no other business income, and there can be one or two more other sources of income. So ITR 1. Where is ITR 2 coming from? ITR 2 comes from, along with all these parameters. If you have secondary properties, like 2 or 3 more properties where you're getting rental income, right? So there could be dividend incomes and things like that. So you can choose ITR 2. ITR 3 is for partnership firms, HUFs and individuals, and 4 is for again, different situations. Like you can refer this table. So I'm not going beyond this point because I'm assuming most of us are in the salaried, salaried people. Now let's look at what are the heads of income for income tax purposes. Basically, there are 5 heads of income: income from salary, income from house property, profits and gains from business or profession. What if you are engaged in a business, or you are working as a consultant? So then your incomes come under profits and gains from business or profession. Capital gains if you are selling, any mutual funds, any shares, any properties in any financial year. So those gains come under the capital gains head. Any other incomes which are not covered in these 4 categories come under the 5th head, that is income from any other sources other than these, right? So now coming to how do you increase your take-home salary with tax planning? Now here we have given 2 scenarios. One is the first column where the person doesn't avail any tax benefits, neither he or she does any tax-related investments. Does investments, and the second column is where the person does not do any tax-related investments. So if you compare, so see, this is a basic salary is 6 lakhs, house rent allowance in both the cases it's 3 lakhs, special allowance 1 lakh, and so the gross taxable income in both the cases is 10 lakhs. Now the first person who avails the tax exempt investments and tax deductions, both the situations, both of them get a standard deduction and of 50,200, right? Exemption availed under HRA is 1 lakh, and salary after standard deduction and exemptions is 8,49,000. So like that, if you see if you take all the deductions, like deduction claimed under Chapter 6 is nothing but the ETC investments, ETC plus another 50,000 comes down, right? So on this, if you apply the tax slabs, hello, Sanjay, can you confirm if I'm audible?
Yes, ma'am.
Okay, thanks. Yeah. So like this, one has to, plan, the investments and exemptions and take benefit from that to reduce the tax liability and increase the take home salary. So, medical insurance, a lot of times what happens, there is very less awareness about how medical insurance can come to rescue in terms of saving taxes. Medical insurance can be taken as a tax exemption under Section 80D. Now, let's look at these scenarios. For whom all can we claim medical insurance premium? There are three scenarios we have discussed, but anything beyond this, we can have a discussion separately. Let's say if both me and my parents are less than 60 years of old. So what can I do? I can take 25%, 25,000 of medical insurance exemption claim for myself, spouse, and children, and another 25,000 for parents. So total tax reduction available will be 50,000. So let's say we are taking a medical insurance where the premiums are about 30,000 for each, like family floater 30,000 and parents 30,000. So out of that, 25,000 each will be given as a tax deduction. So that means on 50,000 you don't have to pay tax. Only on 10,000 you will 10,000 is not cannot be taken as a tax deduction. Let's say if I am less than 60 and my parents are above 60. For parents who are above 60, the tax deduction is 50,000 per year. Okay, and for myself it remains same because we are still under 60, right? So total tax deduction you can claim is about 75,000 on the medical insurance premium. If both yourself and your parents are more than 60 years, then in that case, for both cases, and for family floater and for parents, you can take the 50,000 deduction. That means total 1 lakhs. So this is how you can reduce your income tax liability, maximum to the tune of 1 lakh under Section 80D. A national pension scheme. So most of them, national pension scheme is gaining popularity now because of all the advantages and all the changes that have been brought in, and also tax related benefits. So under Section 80C, up to 1,50,000 you can claim as a tax deduction. So see, what happens is most of the times 1.5 lakhs gets covered in most of the times EPF insurance policies and things like that, like a home loan insurance where you're claiming for principal repayment. So their maximum is 1.5 lakh. So there is very less scope. Additionally, what is allowed is under Section 80CCD, 50,000 per year, whatever you are contributing as a investment in NPS, in that 50,000 up to 50,000 rupees you can claim as a deduction. If you are getting NPS contributions from your employer also, so in that case 10% of your basic plus DA is allowed as a deduction along with this 50,000, right? So this is how you can avail the NPS scheme related deductions. Tier 2 account can be opened, but there is no tax, tax exemption or tax deduction facility available there. EPF. Now, there are some aspects of employees' provident fund that you must be aware. So most of the times, what happens as you grow up the ladder and reach mid management level or senior management level, the contributions go up, and you also happen to do VPF, voluntary provident fund, contributions. So in that case, so if my contribution is below 2.5 lakh rupees towards the EPF, the interest in income earned on it is not taxable, provided the employer is also contributing. Okay. If the contributions exceed 2.5 lakh rupees, then the interest on the component above 2.5 lakhs of your contribution becomes taxable. If the employer is not contributing to the PF anymore, then the limit for tax-free interest on EPF increases to 5 lakhs. That means above 5 lakhs, whatever contributions you are making will get taxed. Now, let's see how you can initiate some investments to manage your risks. We already discussed health insurance, under Section 80D. Life insurance also you can avail under Section 80C. So, life insurance acts as a risk management tool as well to protect yourself and your loved ones in case of untimely and untoward incidents happening. So that also you can claim under Section 80C. So, how can home loan be of use to you? One second. Yeah. So how can you take benefit from home loan? So let's say you have a home loan of 50 lakh rupees and your current rate of interest is 9%. You've taken a loan for 20 years and your EMI is about 45,000. So total EMI that you pay for over 20 years, it will be 1.07 crores. Okay. So out of that, total tax deductions that can be claimed in over 20 years is about 70 lakh rupees. Okay. How is that possible? Is under Section 24, you can claim up to 2 lakh rupees every year as an interest component deduction on your home loan. And Section 80C, under Section 80C, you can claim for the principal repayment. There is very less scope under Section 80C, so you can always look for claiming the interest component on the home loan up to 2 lakh rupees. So most of the times we get asked questions like, what is the amount of loan that I should maintain to take this tax benefit. For example, if the loan is of higher amount, 80 lakhs, 1 crore or so. So then we help them understand that by prepaying partially, let's say 50,000 over the next 5 years, you can reduce it to a level where your interest outgo is not much. It only covers where you can take benefit of these tax exemption under Section 24. So you have to bring it down to a level where it's not too much outgo of EMI. You're also reducing your tenure of the loan, plus you're also availing the tax benefits. So that is the analysis we help our clients do. With this, if you want, we can have a ready reckoner kind of a thing and we can share it across so that it will help you as well. So here, if you see the tax bracket, let's say it's 30%. So effectively, tax savings, if we claim the full tax deductions, like tax saved on the 70 lakh rupees is about 21 lakhs 84,000. So net outflow through EMI after tax savings, if this is a benefit coming in. So if you net, if you see the outflow in your EMIs is 86 lakhs only. So effectively, if you calculate the effective interest rate that was, that the home loan had was about 6% only after taking into effect the tax savings that have come in place. So like this, you can avail, tax benefits with home loan as well. So now what should be the approach to tax, tax filing? So what is a regime that one should look at? So this is a comparison of old tax regime and new tax regime. So you must be aware that after the budget announcement, there are the tax slabs under the new income tax slabs have increased. They have made about 6 slabs here in the new tax regime. And going forward, this is going to be one of the default tax regimes for all of us, right? So up to 2.5 lakhs, there is nil tax under the old tax regime. So just a basic understanding is that if you have home loan and a lot of ATC, Chapter 6A deductions and all, it is better to go with the old tax regime. If your finances are simple and you don't believe in doing any investments for tax related purposes and it is straightforward, then it is better to go with new tax regime. For example, if you don't have a home loan, if you don't have dependents for medical insurance or health insurance or life insurance, or any other aspects as such, you can straight away go in for new tax slabs. So here what happens, there is a additional rebate given. So effectively the income up to 7 lakhs is tax free, considering the standard deduction and the rebate that is allowed. So these are the revised income tax slab rates for financial year 23-24, that is for the next assessment year, right? So it is the same. I've just put it in a numerical format, so it's easy reference. What do these terms mean? So one should be aware of these terminologies. Usually when it is tax filing, So people get confused with what are my allowances? What do you mean by tax exemption? What are tax deductions, right? So what are allowances is, allowances is something given by your employer as an additional benefit to you. So allowances means nothing but a benefit which is passed on by the employer to you for your convenience. So these are most of the times taxable, but there are some allowances which are partially taxable. You can take an exemption to a certain level. So it depends on what kind of allowance it is, whether it is conveyance allowance, food allowance, leave travel allowance, and things like that. So those are your allowances. What do you mean by tax exempt? So an exemption is the right to have some or all of one's income as exempt. Like there is no tax levied on such incomes. For example, house rent allowance. If you're paying rent and you're staying on rent, you can take full exemption of your house rent allowance that is given by your employer. Leave travel allowance, in a block of 4 years, for 2 years, you can claim your leave travel allowance against the travel that you plan in that particular year. What do you mean by deductions? These are some of the claims made to reduce your tax income. For example, there will be some incomes, which are complementary to your. There will be some expenses which are complementary to your incomes, where you have incurred those expenses and then got your income. So net you can claim these expenses as deductions from the incomes that you have earned, so that you're reducing the taxable income in hand and then pay the taxes. So those are the terminologies. So now coming to understand your salary structure. So most of the times what happens, there are a lot of people who tend to just ignore what is there as a salary component in their salaries. So you have to be careful, like, what all things are there in the salary, what are you getting paid for, and how you can claim some exemptions, deductions, to see that less of it is, goes into a taxable bracket. So there could be house rent allowance, leave travel allowance, conveyance allowance, medical allowance, right? So there is PF of employee contribution, and then professional taxes getting deducted, income taxes getting deducted, medical insurance, if there is a group medical insurance, and there is a payable coming as a insurance premium that gets deducted. So what is it exactly that is going into your fee structure? You have to have a better understanding of that. So which is very important for you to plan your taxes. So these are the most availed deductions and exemptions by any individual, salaried individual. Under section 80C, like we discussed, maximum limit is 1.5 lakhs. What all it covers is PPF, your equity linked saving schemes, LIC premiums, tuition fees of 2 children, principal portion of your home loan, right? So that covers under 80C. Under section 80CCD, that is your NPS contributions, like we discussed, up to 50,000 you can claim as a deduction, exemption. Under section 80D, maximum limit is 25K for self and additional 50K for parents. We discussed 3 scenarios, right? Where you are below 60 and parents below 60, where you are below 60 and parents above 60, and the case where both you yourself and your parents are above 60. So how you can take help of 80D. Under section 80G, this is pertaining to donations. There are some recognized and authorized donation vehicles where you can donate, and maximum up to 10% of your gross total income you can make as a donation and take a tax exemption there. Under section 80E, if you have a education loan running, the interest on the education loan you can take as a total interest, whatever you have paid for the year can be taken as a deduction. So under home loan tax benefit, like I was saying, under section 24B, up to 2 lakhs of interest that you paid for your home loan, you can take as a deduction. Every year you can ask the bank or your loan provider to give you the statement of interest paid. So with that, you will be able to calculate how much was the interest paid, and out of that, 2 lakhs can be claimed as a deduction. These are the different options, investment options under section 80C. So here we mentioned, right? So under section 80C, up to 1.5 lakhs of investments you can take straight away as an exemption. So what are those investments you can consider? So these are some of the investments. One is the ELSS. equity linked savings schemes. This is a mutual fund, which helps you in saving taxes. Here, this is a most efficient way to, claim your ATC. Most of them do this, where the returns are more than 10 to 12% in a year because they are equity linked. However, there is a lock-in of 3 years. Up to 3 years, you have to stay invested. That is the only thing, but the returns are better. Anyway, if you have a longer term perspective, if you want to leave it there for 3 years, 5 years, you can choose ELSS. Then there are tax saving FDs also. Now the interest rates are getting better. So anywhere in the range of 6 to 8% is, interest you can get. Here the lock-in is 5 years. Okay. So the interest is good, but the lock-in, if you are somebody who is looking for a more liquid option, then you should not consider these. Public provident fund, here also the lock-in is 15 years. The rate of interest is about 7.1%. So like that. So these are the different things: ETF, National Pension Scheme, unit linked insurance plan. This comes under section ATC. This is also very popular investment. The lock-in depends 3 to 5 years. It's usually 5 years, but there are some ULIPs which give a 3-year lock-in. Sukanya Samriddhi, if you have a daughter who is less than 10 years old, you can invest in Sukanya Samriddhi, which gives a 8% return. It will be like a savings bucket for the daughter. So she can use it once she is 21 years old. She can take it fully in her name, and it will be totally tax exempt. However, after she reaches 18 years old, you can withdraw partially for her education and things, whatever is coming up as a priority for her. Repayment of home loan and principal can be claimed. National savings certificates are also there. So these are the broader spectrum of ATC investments which you can consider for tax savings. So now, most of the times we get asked like, which tax regime will suit me? So this is a ready reckoner which will help you understand where the break-even point is, right? Let's say your gross, for example, let's say your gross income is 5.5 lakh per year, and you don't have any deductions. Then whether you choose old regime or new regime, it's the same impact. So if you are someone who has, let's say 8.5 lakhs of gross income, and you are making up to 1.5 lakh of, let's say ATC investments, then you should go with new tax regime. If there is nothing else, then you should go with these. So like that. So these are this is a ready reckoner. You can maybe take a screenshot of this and look at it. So these are your deductions, whatever deductions, for example, for your rental income, if you're claiming any deductions, for your capital gains, you're claiming deductions and things like that. You can just calculate and look, how this helps you. So there are, you must be knowing that EPF, you can withdraw from your EPF if there is a emergency situation. So what are the rules pertaining to EPF withdrawals? So you can take EPF, withdraw from your EPF in case of a medical emergency for yourself, for your spouse, parents, or children. Okay. So the limit is lesser one of employee's share plus interest or 6 times of the monthly salary. But there are some, terms and conditions here. So we'll discuss each of them. For construction or purchase of house property, if this is the reason you want to withdraw from your EPF, you should be an EPF member for at least 5 years. So how much can you withdraw? 90% of the EPF balance you can withdraw out of this. If you're renovating your house, again, you have to be a member for 5 years. That means there has to be continuous contributions for at least 5 years. And how much can you withdraw? You can withdraw 12 times of your employee's monthly salary. Whatever contributions you are doing, so you have done so far. So 12 times of that you can withdraw. Repayment of home loan. For this purpose, you can so you should have served at least for 3 years. And how much can you take out? 90% of it you can take out to repay your home loan. But then we strictly, if you see, so this is your retirement bucket. So if you pull out from your EPF, you're bringing down your retirement corpus. So ideally, you should see that, at the max, not to pull out from your EPF. only in case of situations like, if there is any dire situation like that where there's no other option. So only in those situations you have to consider coming out from your EPF, because you would have accumulated it from a very long time and the interest would have compounded considerably, right? So if you come out of it, you're not going to enter at the same pace going forward. So then you are reducing your retirement bucket. So for wedding of any of your siblings or dependents, you can take where you would have been a member of the EPF for at least 7 years or more. And how much can you withdraw? You can withdraw up to 50%. So yeah, that is about EPF. Now, how do you claim deduction pertaining to house rent allowance? So these are the three criteria which will decide the amount of deduction that you can claim on house rent allowance. First thing is, what is your actual HRA component received for the year? Second, you have to compare it against 50% of basic salary if you are living in a metro city, or else 40% of the basic salary. Third, actual rent paid less 10% of basic salary, right? So what is the actual rent that you have paid minus 10% of your basic salary? So out of all these three, whichever is higher will get, whichever is lower, you will get the tax. You can claim as a deduction. For example, so here is a small calculation. Let's say house rent allowance a member received was around 3 lakhs. The monthly rent paid is 19,000. So exemption would be the lowest of these three, right? What is your actual HRA received? 3,08,000. 40% of basic, let's say it's a non-metro, so 2.46 lakhs. Rent paid minus 10% of basic is 1,66,295. The lowest of all these three is 166,295, right? So the taxable component of HRA would be 3,08,000 minus 1,66,000, that is 1,42,000. Right, so this is how the HRA allowance and a taxable component of your HRA is calculated. Leave travel allowance. So there are some conditions where you can where you have to be careful about. So where you can claim how you can claim your leave travel allowance. You can utilize the benefit in any 2 of the 4 years. In the block of 4 years, for only 2 years, your travel allowance can be claimed as a exemption or a deduction, right? So only domestic travel, not international travel, only the within India, whatever you're traveling can be claimed, can be shown as a deduction. You can claim any air, train or bus tickets. You have to keep a record of that and you have to claim. Only the travel cost to the destination and from and back and forth destination travels tickets can be claimed as a deduction. Food and any other expenses cannot be claimed. Who can you cover? You can take your spouse, 2 children, parents, and dependent siblings if they are allowed. Yeah. So sometimes we get asked, can I claim deduction on 2 home loans? Yes, definitely you can claim deduction on 2 home loans, whether it is self-occupied or let out. So again the same parameters, 1.5 lakhs under section 80C and under section 24, it is up to 2 lakhs of the interest repayments on both, put together. So these are some of the tax deductions that are available under different heads. Again, salary, you get a standard deduction of 50,000, and then there is employment tax as well, right? Against house property, you can claim any municipal taxes, corporation taxes that you have paid for your house property. So this is for the rental income that we are talking about. Let's say you have a rental property, you can show that you have paid taxes, property taxes, and then there is a standard deduction of 30,000 on the annual value, on the gross annual value minus municipal taxes. So there is a calculation for this. So there is a standard deduction which is allowed up to 30%. Any interest on borrowed capital, any interest on loan that you have taken on this particular property, you can show that as well. Okay. And if there is arrears of rent or unrealized rent received, there also you can take 30% of those arrears of the rent. The rent that was supposed to be received earlier has come in now. So out of that, up to 30% you can claim as a deduction. Interest against capital gains of house property. Let's say you have sold one of your long-term house properties. So what all can you claim as a expense out of the gains that you have that that you have got from that property? So one is the brokerage or commission that you will be paying to secure such a purchase. For example, if you're living in any other city and you have if you have hired any broker, or if you're using any hotel where you're paying fees to look for a buyer for your property. So such brokerages, commissions, or expenses can be claimed as a deduction from those gains. Cost of any stamp papers that you would have incurred, travel expenses in connection with the transfer. For the transfer to come into effect, you would be required to travel to the place where this property is several times to finalize the deal, right? So those expenses you can also claim, provided there is a proof, you have maintained a proof for the same. Where the property has been inherited, expenditure incurred with respect to the procedures associated with the will and inheritance. So any succession certificate, so cost of the executor, so all that can be allowed as a expense under the head's capital gains from house property. So let's look at capital gains in terms of shares and mutual funds. So here, for shares or equity mutual funds, if you're selling the shares or equity mutual funds within 1 year of acquisition, so that is termed as short-term capital gains. And if you have, if you have enjoyed any gains on that, if you have enjoyed profits on that, that is called short-term capital gains. So here, any short-term capital gains, tax rate is 15% plus cess plus surcharge as applicable, right? 15% is the tax rate on short-term capital gains. If you have held the shares or mutual funds for over a year and then you're selling it, and then there is a profit on these, then up to 1 lakh, if your profits are less than 1 lakh, then there is no tax on such gains. But if your profits are going over 1 lakh, then you will be taxed at 10% on those excess returns over 1 lakh plus cess plus surcharge. Okay. In the case of debt mutual funds, now all so this was there earlier, but now the 20% and indexation benefits have been taken out. So debt funds are also taxed as per your income tax slab rates. So it's a straightforward tax there. Short-term capital gains are calculated in this manner. So your full value consideration, that is the sale price, minus the expenses that you incurred exclusively for such transfer, minus the cost of your acquisition or purchase price, and any cost of improvement. For example, if it is a house property, you would have spent some repairs, tiles, redoing the tiles or any renovation of that kind to improve the property. So all that can be taken as a cost. So those can be deducted from the selling price, and then you can pay tax on the remaining amount. So how are long-term capital gains calculated? Again, in long-term capital gains, you will get a benefit of indexation, which is nothing but adjusting for inflation, right? So let's say long-term capital gains for house property against the full sale value, you can deduct your expenses incurred for such transfer. Then indexed cost of acquisition, that is inflation adjusted purchase price. Then you can also deduct indexed cost of improvement, that is inflation adjusted cost of renovation or cost of improvement or any repairs that you have done. So like this, the indexation benefits are allowed. So this is the calculation of how indexation is calculated. So how do you arrive at indexed cost of acquisition? Cost of acquisition, that is your purchase price, multiplied by the cost inflation index of the year in which the asset was sold, divided by the cost inflation index in the asset which was in the year the asset was purchased. Okay, so cost inflation index is nothing but an index which you get, if you look for it in Google, you will get the cost inflation index. So you will be able to calculate the indexed cost of in this manner. So it is nothing but adjusting. So over a period of time, the value that you purchased, let's say you had purchased something at 10 lakhs about 15 years ago. the value of that 10 lakhs would have reduced over a period of time because of inflation, right? So effectively, let's say you have sold the property for 30 lakhs now. So effectively, your gains will be 20 lakhs, but it is not so because your the purchasing power of money has reduced considerably. So to adjust that inflation, so this is a calculation that is done to arrive at the indexed cost of acquisition. So this is the end of tax planning. So now, how can you avail, look at financial planning and wealth creation? So so tax planning, investment planning is one of the important elements of, the overall financial planning. So what is the life cycle or personal financial life cycle for any individual? Let's say, this is the broader, kind of segregation we look at, because every individual, depending on the age bracket, the responsibilities are different. The way they look at, accumulating wealth, or the way they are managing their taxes is different, right? So let's say there's someone who is in the age bracket of 20 to 39. So he or she is in the early earning years, building a career. There is a possibility of marriage and starting a family also. There is a possibility of buying a first home, where the home loan and mortgage are also there, right? How do they look at wealth? They are very aggressive investors because the earnings are on the high, on the rise. The promotions and everything are, coming in faster. There is faster income growth, and then their risk appetite is also more because they are young and they are confident of, earning quite well in the going years. So, and the perspective is long term there, right? They want to manage debt, maximum, and reduce the loan amount to, faster. Before they reach 50 years or 40 years, they want to finish off the loan aspects. So these are the kind of things. Someone who is in the age bracket of 40 to 59 years, the earnings that are at peak because it is someone who is going to enter the mid or senior level management, those kind of promotions. The earnings are, very, very high. They have established very well within their careers. At the same time, they have aging parents, growing children, children's education, marriages. What is the life, wealth life cycle that, how do they look at, wealth creation or wealth cycle? They look at more from a capital appreciation perspective. They are in the mode of, increasing their, contributions because they'll be nearing retirement in some time, and all the, children's marriages and all are coming, faster. So they'll try to push more and more into, savings. Retirement planning is at its peak, right? So all this is a kind of a wealth cycle. So like that, for, above 60 years, what happens is, basically that is when somebody would stop working. Nowadays, after 55, nobody likes to work. So 55 onwards, this is the kind of thing we will see where there's a decline in earnings. Maybe somebody is doing a part-time job or something that they enjoy, like a hobby or something, which is giving some form of income to them. And they would have, throughout their career, they would have planned for some passive income. So those incomes are coming in. So the earnings are declined. So expenses are also not on a large scale because children are on their own. Their marriages are done. Or marriage is not over in the picture. Maybe their children are capable to do that on their own or something like that, right? So the agenda is to look at a phased retirement option, like what do I need for the first 5 years or first 10 years, then how do I plan, and things like that. So now that there is more time on the plate, they might also look at spending time differently, whether it is a travel or whether it is aspiration they are considering and things like that, right? So what do they look at from the wealth perspective? Here, the most important aspect is wealth preservation. Above 60 is, it's usually wealth preservation, and we as financial advisors also advise not to, take over risk. Capital preservation is something we have to prioritize. How to manage the market risk? So, like, how do we set aside only a portion of it which is growing, which is market linked and which is growing at a little bit aggressive rate, and rest of it is in a bucket which is giving payouts, or which is a safer asset class which is helping in capital protection and things like that. Then the estate planning also kicks in, estate planning or succession planning, and things like that, writing a will, whether it's creating a trust or anything. So those are the things that will come into the picture. So this is how an individual's personal financial life cycle is based. So based on this, one has to look at different aspects, like what these days there's a lot of drive towards financial freedom. So what is financial freedom? It is very subjective. Every individual has his or own her own thought process, like what is financial freedom for me. If somebody asks, like, right, somebody might say, I want to live a debt free life, so I have a loan, I want to just close that. Once I close that, I feel a sense of freedom, and that is what is financial freedom for me. Somebody else would say, I want to achieve all my goals, like children's education, my travel goals. I want next 10 years, I want to see these places. I want to achieve that in the next 10 years. So that is sense of financial freedom for me. I want to have a peaceful retirement. So that is a sense of financial freedom for me. So it all starts with how do you look at achieving sense of freedom step by step. For someone who has a financial security, for example, someone who has all the risk management tools taken care, like if something happens, there's a lot of cushion which can take care of everything. Whether there is accident, then there is accident related. Let's say he or she has taken a personal accident insurance, which covers for permanent partial disability, income protection, lump sum benefits, and things like that. So that is a kind of financial security we are talking about. Let's say an individual, that is one element. Let's say an individual has made enough, into financial assets where the children's education is taken care, it is staying invested, it is growing at a 12-15% rate of return. And the children's educations are like, 8 to 10 years away, but still the corpus is, handful and things like that. So that is a sense of financial security that one can have. So after this, financial security and the bottom line of risk management, then comes the financial freedom, right? So what is financial freedom is you have enough passive incomes where all your goals are taken care. You have enough passive incomes to take care of your expenses for the rest of your life, which can help you maintain your lifestyle, help you spend your time as you wished, as you desired. So that is the stage of financial freedom. So it is nothing but allowing you the freedom to achieve your ideal life, where you no longer need to work to make a living, but working becomes a matter of choice after a certain point of time. So financial freedom is that. To some others, it also means that I should be able to switch between jobs more conveniently without feeling constrained that, if I leave this job, it is going to impact my family or things like that. So it all comes with securing your finances 360 degrees, correct? So how does that come? So it has to be, there has to be smart planning. So we do something called a smart goals planning. So your investment should be, goal focused. Goal based investing is something that we call it. So it all starts with a good financial plan. So you have to define your goals appropriately. They have to be specific, they have to be measurable, achievable, realistic, and timely. So only by that you can have a direction to your investments. Otherwise, your investments is just like shooting in the dark if there is no direction. So you can create different buckets for different goals of yours. Some bucket for your children's education, some bucket for your retirement, some bucket for your travel needs, and things like that. Some bucket for your parents' needs. As they're growing old, you want to set aside something to take care of their medical needs apart from the insurance elements. So whatever it is, you put it under different buckets and set a timeline for the same. Setting a timeline, giving it a measurable amount, like how much I will need after 5 years, how much I will need after 7 years, considering the inflation. So those are some of the things will set direction for your savings and investments. So which is very important. How do we do that? So it all starts with a good financial plan. So you have to create a good financial plan either with the help of an advisor, or there are a lot of tools available online these days which will help you create your financial plan, right? So whatever it is, you have to understand that it all starts with how you manage your risks, your contingencies, and how do you create those smart goals and start planning to achieving them, right? Let's look a small video which will help you understand better.
For building a house, it is essential to create a perfect blueprint for the same. Similarly, for building a wealth for you and your family requires you to build a financial blueprint. For building a house, it is essential to create a perfect blueprint for the same. Similarly, for building a wealth for you and your family requires you to build a financial blueprint, also known as financial planning. Here are the 5 steps of building successful financial plan. Planning for uncertainty. First step is to protect yourself from uncertainty by buying required insurance policies to ensure that any uncertainty do not eat up your savings. Build contingency corpus. Second step is to build contingency corpus up to 6 to 9 months of your monthly expenses. This will protect your long-term investments from the contingencies like loss of job or slowdown in business. Set financial goals. Third step is to set financial goals and find out when and how much money would you require to achieve these financial goals. Create portfolio. Fourth step is to select right asset class and product to invest and to achieve your financial goals based on the time horizon and your risk appetite. Portfolio review. Fifth step is to review your portfolio periodically and do the necessary adjustments into it based on the remaining time period to achieve each goal. To create a financial plan and to review it periodically, always take the help of your financial advisor.
So that is how it works. So the bottom line of any good financial plan is to first ensure that all your risks are mitigated. Like there are tools and techniques that that are there to take care of any contingency that comes in. So that is why we whatever goals a client has given us, we first take emergency fund as a default goal or a priority. As a priority to achieve that, and then comes the retirement and then children's education and things like that. So priorities. So starting with identifying the goals and then prioritizing them and then working towards how to achieve them. How do you map your existing savings and investments that you have accumulated, assets you have accumulated so far? How do you map them to your smart goals, and then what is the way forward? Whether that is enough to take care of the needs, or anything more needs to be done. What is that adjustment that needs to be done to your existing portfolio and your savings? How you can optimize the same and reach. If you have planned for a 15 years horizon for taking care of complete goals planning, look at finding ways to achieve it by 10th year, so that there's no last minute rush, or there's a lot of scope for financial freedom and looking at the other aspects of life. Like any aspirations and how do you go about it, spending more time with family, spending more time with friends, doing something that you enjoy and love and things like that. So it all comes with a good financial plan. So whatever the plan is, one should always remember that whatever savings and investments one is doing, there has to be a lot of discipline and savings that comes in to create good amount of wealth. Right? It only comes with time, perseverance, consistency, and patience. Right? So that is what is something called as power of compounding. It only comes when you spend time in the market instead of timing the market. So that's a very good saying. Like we don't know when to enter the markets. Right? When should I invest? When should I come out of it? There is no set timelines for this. So what we have to do is, on a broader level, understand that whenever there is an investment opportunity available at a discounted price, at a reasonable price, so purchase that on a larger scale, push more into, find some sources and invest more in such avenues, and then wait for it to grow for next, 3 years, 4 years and things like that, whatever is your horizon, right? So until your goal year is nearing, do not touch this fund, whatever, irrespective of whether market is going up or down every day. Because in the short run, what happens is markets are very volatile. They tend to fluctuate rapidly, but in the longer term, they will revive. The markets in my last session, I also I dealt with investing mistakes, where I discussed the cycles. The markets also go into cycles. the peak, then the bottom, then the corrections and things like that. So one has to understand how the markets are heading and what is driving the markets. So what we are trying to tell you is a lot of financial education involvement is important to understand where it is heading. So just because somebody is advising your friends and saying that abhi market upar ja raha hai, invest karo, niche ja raha hai, mat karo. So all those are like very very vague things of looking at the overall financial well-being. So what is more required is understanding from your individual personal standpoint what is appropriate for you and your family. So you have to make those informed decisions by educating yourself and your family members with a thing. So, if you look at this example, it just explains the power of compounding. These two individuals start investing at different ages in their career. Let's say one starts investing at the age of 35 and one at 25. If you see at the age of 35, because of the lost time, he or she will have to start investing more per month to achieve a certain level of corpus. That is one. So the time that Mr. Gupta, who has started at 25, the time that he has given for his investments is more, and the time that Mr. Saxena is giving is less. So likewise, even if he is doing more, the corpus that is achieved at the end of it is lesser than what one has started earlier. So what this says is, with every lost time, there is a cost. With every delay that one does, in investing or taking those important executions for the portfolio, any lost time is a cost on the portfolio. So the sooner you start this and the more time you give to your investments, the better it is to achieve your overall financial goals. So this is another important video that I'm going to play, which shows the story of a Chinese bamboo, and how do you relate that to your SIPs and what it means?
Chinese bamboo is the world's tallest grass, which goes up to as high as 80 to 90 feet in a little over 5 years. When you sow the seed and start watering and nurturing it daily, you don't see it growing for 5 years. It would be frustrating, isn't it? But wait, miracle happens after 5 years. It grows from 0 to 80 feet in less than 90 days. Similarly, growing well through SIP also requires a lot of patience. Had you started an SIP of rupees 10,000 in September 2010 in large cap fund, the value of your total investment of 3.6 lakh rupees would have been 3.57 lakh rupees after 3 years. Had you stopped an SIP, this temporary loss would have been permanent loss. But had you continued an SIP, at the end of the 4th year, your value of total investment of 4.8 lakh rupees would have been 6.95 lakh rupees. And if your SIP still continues till March 2019, the value of total investment of rupees 10.3 lakhs would have been 17.38 lakh rupees. Remember, correction is temporary. Growth is permanent. So continue your SIP for long term to create wealth. Mutual fund investments are subject to market.
So that is how you have to give time for your investments. Initially, you will see that your investments are going nowhere. 3 years, 2 years, 3 years, you see that there is very less, returns, or there is no returns, or even you can see that some investments are going negative also. But that's just a short term. What is a long term is anything above 5 years is a long term for any investments. So if you have a goal horizon more than 5 years, so you should not be worried about short term fluctuations in your portfolio. So if you see a correction, a good correction, and if you see that the same investment is available at a very, very discounted price, then you should look at adding more rather than stopping or coming out of that investment. Right. So those are some of the important things one has to be careful. So this is a thumb rule that most of the times people ignore. So what happens when somebody gets a paycheck is most of the things go in the needs of the family, like regular expenses, EMIs and things, and then what one feels is after spending end of the month, if something is left over, then I will look at saving it. That's a wrong way to go about it. It has to go hand in hand with your regular expenses. you have to make some way for investing at the beginning of the month. It's better to do an automation of an SIP or automation like how EPF is like a silent accumulation at the back, right? So just like that, if you automate your SIPs, it will be a silent accumulation of wealth, and so that gives more scope for better savings in your thing. So on an overall basis, at least 20 to 25% of your total annual income or monthly income has to go in your savings. So that is how you should look at saving first and spending later. Power of asset allocation is one of the important things which will take you a long way. Along with tax planning, when you're planning your investments, you should look at asset allocation. What is that mix of assets that will give me good inflation adjusted returns along with helping me preserve my capital? So that identifying the mix is very important, and that depends on age, in what age you are. As a thumb rule, what usually they say is 100 minus your age is what you should look at investing in equities, right? So that is how it is. So you can do the math. So under equities also, what are the kinds of products you want to put, whether it is direct stocks, whether it is mutual funds, whether it is PMS, equity linked savings schemes for that matter, whether it is bonds, corporate FDs, what kind of a mix you want, post office savings schemes, right? PPFs. So what is that mix that ideally suits you and your goals is something which you have to work out, right? So why you have to diversify into different asset classes, right? So in my last session also I had dealt with this, how diversification is important, why diversifying investments into avenues which are negatively correlated with each other. How will that help in the periods when equities are not doing good, when the other asset classes are doing good? How will that help you balance your overall returns? Is something I have dealt in my previous session. So the link is available on YouTube and on our YouTube channel. You can visit that link. But just to explain why asset allocation is important, so here's a video.
In a multilingual country like India, cricket is a common language 1.3 billion people speak. But do you know, this most revered sport in India has many similarities with investments. Let us have a look. Can you imagine a team of only batsmen? Never, right? We need a perfect blend of batsmen, bowlers, and fielders to win the match. Similarly, to succeed in the game of investment, diversification is the only winning strategy. Just like a balanced team, we need a balanced portfolio to give us better returns. We can't hit the boundary on every delivery. Singles are just as important as boundaries. Similarly, we should invest in debt and equity. Equity provides us high returns when the market is good, and debt provides us consistent returns when the market is tight. Interesting, isn't it? Based on time, there are three different formats of cricket, and we select players based on their track record for each format. Similarly, we have different investment horizons, whether short or long term. We must select funds according to our goals only. Lastly, just like a captain is necessary to lead the team, similarly, we should have a professional to lead and guide us throughout the game to ensure the suitability of products we buy. So, we hope you will play this game of investment pretty well now and win the World Cup of your dreams. For more information, kindly contact.
So, so there are different asset classes which will, perform at different times, right? Similarly, like, in the video, it was being said that every time it is not important to hit a boundary, the singles are as important. So similarly, not all asset classes tend to perform at all points of time. So you should be patient and look at which asset class performs at which market cycle. So just stay invested, and a good mix is very, very important for the long term success, financial success. So we are coming to the end of the session. We have overshot the time by 5 minutes. So this is the last thing. So what is the path to financial freedom? You have to set your life goals. You have to set smart goals. Have an emergency fund. Stay insured. Sticking to budgets is very important. It brings in disciplined way of looking about your expenses and savings. Staying away from bad debts like credit card loans or a personal loan or a hand loan. You should just try and stay away from these. Automate your savings. The best thing to do is to start now. If you have not already done your financial plan or your tax planning, you have to do it right away. A good asset allocation will go a long way. When do not panic with short-term volatilities. Try to step up your savings every year and monitor where your investments are, how your investments are doing. So these are the stages of wealth creation depending on one's experience and one's life cycle stage and things like that. So it goes like it's a step-by-step approach. First is to understand now which asset class suits me, which will help me achieve my goals, and then comes where I can take a little bit more risk, where I have the bandwidth to play around and try my hand and take a little bit more risk, and look how other asset classes or some different types of investments can help me. Alternative investments or something like that, which are a little more risky, but they are giving good returns. Is there a scope for me to enter that space now? So it has to go step by step in a step-by-step approach once your basics are covered. So this is a kind of a hierarchy that we look at. What are the key takeaways of today's session? Tax planning is very important, and at the center of it is you yourself is responsible. Start planning your investments, start planning your finances and taxes on time. The best way is to organize everything, systematically, automation and things like that. Like I was saying, every day or every time missed or a delay, there is a cost involved. So every rupee you save today, you are buying yourself a financial freedom. So diversification is also very important. So those were the things today. So this is about the Right Horizons. We are based in Bangalore at Panerghatta Road, and we also operate from Mumbai, Chennai, and Hyderabad. So that's about us. So we'll take the questions now.
Thank you, ma'am, for this insightful session. I think we are already having few questions in the Q&A section. Please, we can
sure.
take it.
Sure. Let me go through. So is PPF interest taxable? There's one question. No, PPF interest is not taxable. That is why it is a tax-free investments. So what it gets accumulated in the PPF itself, and you can withdraw it after 15 years. If you withdraw it after 15 years, whatever accumulated corpus is there, so that entire corpus is tax-free. Only if you do partial withdrawal, there are certain limits to it. So that is why it is a tax-saving instrument. So there is a restriction on withdrawals to make it non-taxable.
Can you make it full screen? The presentation. It's not good.
Yeah. Better now?
Yes, ma'am.
So yeah. There's one more question, like if I'm the owner of the house, then how we can be claimed? This question is, I think it's half Mr. Alok. Maybe we can connect sometime later and take this. So there's one more question. Can defense employee invest in NPS Tier 1 and claim tax benefits? If I invest only 50,000, in which section can I claim ATC or ATCCD? I have seen NPS is not mandatory for Air Force personnel. Yeah, NPS is not mandatory, but as an individual, you can always opt for NPS contributions. I'll come back to it, although I'm not sure specifically defense persons. I don't think there's any restriction on defense personnel, but let me come back to you with more details on on these. I'll definitely connect after the session. Mr. Sayant and Devnath. Yeah. SWP is a good option to invest lump sum amount to regular income or go with other option. Mr. Anup Singhal is asking, can I get the PPT of the same? Okay. So SWP is systematic withdrawal plan. I'm assuming you're talking about systematic investment plan where you want to invest. So yes, SWP or systematic transfer plan, where those are the ways where we are staggering the investments over a period of time. We don't want to, because we don't know what levels the markets are today. So it is at all-time high, right? So it might not be a best time to enter a lump sum, right? Because the markets tend to fluctuate. If you invest everything today, and if the markets tend to correct maybe 1 or 2 weeks later, then that will be a more suitable time. But we don't know where the markets are heading and what will happen in the future. So best is to phase it out and do it through a SIP or a STP for at least a 6 to 8 months period of time, depending on the economic scenario, right? Lump sum, when you have to do is, for example, if you're choosing a balanced fund or a balanced advantage fund, there you can do a lump sum. But when it is equity, you have to go a little cautious and do it staggered, so that your cost price is getting averaged out and you are maximizing your returns.